Hey everyone, it's Imran back again with another Trader Chats episode. Today I'm honored with the presence of Mish Schneider. That is how I say it, I think, Schneider. And she's coming from Market Gauge, and she's going to tell us all about that because it's not something I know that much about. But the name of the episode is Finding Edge in Multi-Asset Trading. That's something that Mish does a hell of a lot of, and we're going to find out all about it. So pleasure to meet you, Mish. How's it going?
Great. So nice to be here, Imran. Thank you for having me on.
No, thanks a lot for coming. So why don't you tell us then? Tell us what Market Gauge is, what you've been doing in your trading career. You've been trading for a long time. Tell us all about it.
Well, I'll start with Market Gauge because that was actually an evolution coming more from my husband, Keith Schneider, who I met as a commodities trader down on the New York Commodities Exchanges, which is where I started my career. And so Keith was a trader in all of the different markets, but he always was fascinated by really creating tools and technology to make trading easier. And that was really his whole thing. So he started a company called Market Vision, which was eventually sold to Reuters. And it was viewports, really being able to look at different charts at the same time, which right now sounds like, oh my God, big deal. But back then it was revolutionary. And also considering I was using an old Quotron when I first started, which was, the boring green and white screen, one chart at a time. So really, once he got through the Market Vision days, and in the late 90s, early 2000, he started another company called DataView, and that was really tools, particularly scans for institutional investors. And then eventually what happened there was that it switched over to the retail space. So once we got into retail, we really expanded our products, not just tools and education, but also we started developing quantitative models probably about 12 years ago, which is something he always wanted to do. And we used really basically the premises of what we learned from on the floor so that we would have built-in risk parameters, for example, profit targets, and that we would look across asset classes, creating a real blend of models so that we could take advantage of whatever is hot. So that's kind of the skinny there. That's a publishing company. Since then, we've also developed MG Pro, which is basically information and a bridge between that and our asset management company dealing with the professional and the RIA. So we also have an RIA called MGAM LLC. So it's been quite the journey. And all started with me as a little girl walking down onto the Commodities Exchange and saying, wow, this is really where I want to be.
Yeah, it's got quite an energy, hasn't it, a trading floor, right? It's just you either love it or you hate it. But if you're in the camp where you love it, then you don't want to be anywhere else, really. Right.
Yeah. And I mean, of course, I was obviously different since there were very few women on the floor. But it really never was much of an issue, quite honestly, as people might suspect. Actually, it kind of worked in my favor because I got a job with Continental Grains Future Division Conti Commodities with zero experience. And I think it was because they were trying to bring more women in because the whole industry at that point was getting a lot of flack for not having any women, really. So that got me in the door, interestingly enough. And then once I was there, it was a fantastic man's club that I got accepted into. Of course, I also had a good personality for it because I could take a good ribbing. I was very physical athlete, so I was able to stand in the pits. And I was so eager to learn and to help. And I became a chartist pretty quickly because it was obvious that I wasn't going to be able to stand in the pit when things were going nuts and physically compete because not even my body so much, my voice, which didn't project. So a couple of schoolyard whistles sometimes I would use, but often I'd step outside the pit, chart, and ask one of the guys to do the orders for me. And that's kind of where it all got started. And then, you see, if you're trading, let's say, coffee, sugar, cocoa exchange, which is where I started, and that is hot, great. But then if that starts to get quieter, then you look over and you see, oh, COMEX, gold, silver is going nuts. So then you kind of go over there, and the same thing with oil. And I was in all of those three exchanges, in NYMEX and Farmex. And you keep moving to where the action is. And that's really kind of the way that I still see things is, where's the action? Let's go there.
Yeah, and that's really interesting. I think it's because you started in the pit. Like you say, you just need to look across over there, and that's another asset class. And so you're in physical proximity to all of the other asset classes. So why would you not be interested in what's going on there, especially if your particular asset class goes a bit quiet? It's exactly the same thing that happened to me on the trading floor when I started. I was a single, no, I wasn't. I was an index trader, and I used to trade the FTSE book. And my God, 2004 and 5 was the quietest time ever in the FTSE. I mean, it just would never move. And I was so bored of it. But right across from me, there was a bunch of single stock traders who were trading all the different sectors and all the different singles. And the mining sector was absolutely exploding in that time. So I was like, all right, I'll get involved with that. And so that sort of perked my interest into saying, I don't have to just pigeonhole myself and trade one thing, because there's opportunities all over the market, right? And if you're not listening out for those, then you are going to miss out. But people get scared, right? People get scared to trade multi-asset because they're not an expert in the field. And if they're not an expert, they don't feel comfortable playing in it. So I guess that how do you kind of manage that, right? Because it's hard to be an expert on everything. So I know how I do it, but I'd like to know, how do you kind of make sure you don't get your fingers burnt going into a space that you don't spend that much time in?
Well, a few ways. And by the way, you're absolutely right. There are so many people, even on the floor, that I would see just sit in the pit where they would be comfortable and sit through long periods of zero momentum and very low volatility. But I think number one is charting. It's a universal language, right? So it doesn't matter what you're trading. If you know how to read a chart, you know how to read a chart. And that really was my expertise. And charting, of course, looks so different now than it did back then, because we did not have electronic trading, right? So I was hand drawing charts. I was hand drawing point and figure charts on an intraday basis. And then I would get something called the Commodities Perspective every Friday in my mail, and in my actual snail mail, right? It was before email. And I would sit over the weekend and I would draw in the high-low close of every day to the following week until I got to the next Friday issue. And so all of that, you start to learn about consolidation and trend lines, and then you start to understand volume. And even though I wasn't necessarily watching volume in terms of a bar against an average volume, you knew volume coming in just from the mere sound of it. And the same thing with momentum. So if you apply all of that along with a good strategy of understanding how to get in, and we were all about the opening range, by the way, because on the commodities exchanges, it opened month by month. And then there would be the reopening of all the months. And so we started to figure out that the range that was made in that initial month by month opening became the actual opening range. And we've expanded on it since. But then if the market reopened and it took out that high of the initial opening, there would be followed to the upside and obviously inversely to the downside. So you just apply all those same principles with a risk parameter, and understanding that once you get, we were day traders back then, but once you get a certain amount of momentum in something, it's time for you to take a profit, and you start to understand risk reward. And really, basically, that's how it applies. So it's not as easy now as it was on the floor, because you were able to use all your senses. You could just see, hear, taste, feel what was going on. But in the world of electronic trading, if there's something I'm interested in, I'll still use everything else, but sometimes I may just take a smaller position size if I'm trading something I've never traded before, until I understand more of the personality of how it trades, and not necessarily the fundamental, because the reason why I'm going there is I'm assuming the fundamentals are lined up, and we're just looking for the technical signals to reinforce that.
Yeah, that's really interesting how you say the personality of an asset, because it's so true. And it's very much technical analysis types that I know have said that. They've said, like, you might look at the RSI and the RSI will have a certain support zone in a certain asset, like the S&P, right? It might be that RSI is always bouncing off 50 or whatever.
Mm-hmm.
But on a different asset, it might be 30, that level that you care about, right? And it's kind of like the signature of the asset that's being carved out through history. And it's like, that's what you're kind of getting on a chart, right? You're paying attention to that signature because that is the amalgamation of all the market participants who play in that space and their market psychology. And it's all there on the page for you or on the screen for you to decipher and for you to identify patterns in, basically. That's the idea.
Eloquently said. I absolutely.
Yeah. All right. So then in terms of your models and stuff that you do at Market Gauge, so it sounds like it's mainly technical analysis driven. Is it like systematic and CTA style? So your trend following, momentum following models, is it mainly that type of stuff that you're doing?
Yes, basically, yes. We have a proprietary trend strength indicator that we use that ranks different stocks, different sectors. And so essentially our signals are definitely technically based. However, there is fundamental component just written into the coding. And so essentially we started out, for example, with something that we called alpha rotation, which was just following the SPY, the NASDAQ, bonds, or you would go into cash. And that was really working well, obviously, until 2022, when the S&P and bonds were going down, right? And so, and we've created things, NASDAQ All-Stars, which is just stock-related, the top performing stocks within the NASDAQ 100. We've moved on to small caps, large cap leaders, GEMS, which is basically global macro. And so we really, yes, that's essentially right, is that it's technically driven, but the quants themselves have been developed from the fundamental basis so that we have exposure and a competitive edge no matter what's going on. And that doesn't mean that every model is always going to do well at the same time, but that's where your risk parameters are really sort of put into it or coded into it as part of the model, and the same thing with profit target. So for like example, this year, we got long Meta, NVIDIA, semiconductors. We even do some leveraged ETFs with semiconductors and some of the other stocks within there, AMD, et cetera, et cetera. And it was before I was really even convinced that technology was going to do what it did and AI was going to be the big buzz of the year. The models got us in. And that's why I love the pure math of them. That doesn't mean I don't have my fun trying to guess what's going to happen next fundamentally. And that's kind of what I've been known for at this point.
And those models, were they picking up the idea that the downtrend was going to get exhausted? Or was it that once it had already turned and it was starting to gather momentum that the models picked it up? Like, are you also able to identify the inflection points and the turning points?
Well, some of the models, yes. Like, for example, we got long in the miners, in the gold miners and gold and silver, and even the agriculturals through the DBA at much lower levels. As soon as they consolidated and cleared the 50-day moving average, for example, the models got in long before they really made that huge move up, right? So particularly in gold, the model was long when gold was trading at about 1,700 and actually exited completely based on the not only initial profit targets, but then we have a trailing stop. It exited at around 1980 when gold, after it took out 2000 and then came back off. So that's kind of how they work. They anticipate, but the anticipation has to be based on some technical signal. And each sector would have its own obviously parameters. Now, I have to admit, I'm not the expert. The expert on that is sitting actually right behind me, right, James? James Kimball has been working with us for 10 years. And he and Keith Moore being the architect, James really being the guy who's been able to put all these ideas into coding them and then creating these models. So we have about 8 of them now. And what we're doing is not only selling them on a publishing space for people who want to follow them, but we're also in the RIA doing blends so that you can decide if you're a high net worth or if you're another institution or you're an RIA yourself, what blend you might want based on your risk tolerance. Are you a conservative, moderate, or aggressive? So yeah, all of that goes into it. It's much more complicated than what I'm saying. But yet this year has just been phenomenal.
That's good. Yeah. I've seen some of the numbers on your website, and it's like, outperforming like every benchmark possible. Okay, that's cool. And then, well, we touched on it a little bit before. So you look at multiple asset classes, right, to go where the action is. I mean, where do you think the main action is now, outside of tech stocks, for example? Is there anything in particular that you've got your eye on?
Absolutely. And by the way, added to the quant models, of course, is the discretionary trading. They're going to have to, I'll have to be dead before I stop trading because I love trading. I've changed the way I've traded through the years. Obviously, I started out as a scalper back in the day on the floor. And now, as a much more mature person, I don't feel the need to scalp anymore, although there are some really great day trading days. I just kind of let them go by because you have to keep your focus. So getting back to your question, the reason why I'm mentioning that is what I'm always doing is I'm somewhat of a contrarian in that I'm looking for the opportunities to set up before everybody else is, because everybody else is busy buying AI and tech and talking about that. I'm meanwhile looking, okay, so let's talk about inflation. Here's the perfect example, right? So we just had CPI this morning. Inflation is down consecutive months in a row. Oh, it's really cool. The Fed is going to stop raising rates, et cetera, et cetera. But I am an old commodities trader. And meanwhile, I'm scratching my head going, well, if that's the case, why are we still seeing gold at elevated prices? Silver took a huge run today. And then, of course, if we're really going to be able to support all this technology, we need raw materials, particularly if we're looking at alternative energy. They're still in shortages and scarcity. If we're really going to be trying to build infrastructure as past with government spending towards that, what is going to be required to do that? So I start thinking, what aren't people paying attention to? And that's what I start talking about when I go on Real Vision or Fox or wherever I go. And that's what we establish our positions in as well. And so sometimes I'm rewarded immediately, and sometimes I kind of have to sit for a while.
Yeah, I mean, I think after last year, commodities got a bit crowded, didn't it? Right, because it was the place to kind of camp out while stocks and bonds got trashed. But then that's why that's been a bad trade. So certainly the energy trade has stung a lot of people. But now oil's showing some green shoots, I guess, right? So yeah, it may well be that the metals and oil and stuff have another run, and that is at some point going to feed through to inflation, as well as the base effects that they're going to feed through to inflation, being stickier than people maybe would want, right?
Oh, well, of course. And yes, is it surprising that used car sales are down, or certain prices, even in the rental market in terms of housing, is down? No, that's not a surprise. All that elevated price happens really pretty much because of COVID. But what has happened under the surface and has not gone away and will continue to be a factor at least for a while is that before COVID, production was cut so much in a lot of raw materials because the costs were so cheap, right? And now here we are having geopolitical issues. Obviously, Russia again is coming out and threatening to stop exporting their grains through Ukraine because they're not happy with what's happening with the whole NATO thing right now, or whatever the reason is. Russia is not going away. So that's just one example. But even wage increase in the UK, obviously, you know that they raised wages considerably, and the pressure is on globally for that to happen. Strikes are happening, and all of this is sort of, I feel, rumbling under the surface between the geopolitical strife, the social unrest that right now erupts just in pockets and then dies down, but could get worse. Especially if the Fed is forced to, and central banks around the world are forced to continue to raise rates. So you've got higher inflation in areas like you can't control. Through Mother Nature would be the next factor, right? Because look at the weather patterns have been incredible. and have created huge shortages, like rice right now in China because of drought is in a huge shortage. And so these are all the things that I pay attention to as an old commodities trader. And the nature of commodities is to be volatile. That's kind of what we expect as commodities traders. There would always be great opportunities on the upside and even faster opportunities when things would correct or go down or go into a protracted bear phase, right? So, and then oil, like you mentioned. So like a few weeks ago in June, I was looking at the oil chart, and it was right when Goldman Sachs said that oil was going to go much lower. And I'm looking at the fundamentals. Well, OPEC cut back, Russia and the Saudis cut back. Our strategic oil reserves here are really low. The US didn't really go in and buy the oil that they were supposed to when we got down to $67 a barrel, which means if oil prices go up, we're kind of caught short here in the US to be able to release more oil. I'm looking at all of the stuff, and I'm looking at the chart. And one of the indicators that I saw, not to mention the fact that I like if something looks like a triple bottom, every time we've had a spike down, gold sort of stopped at around that $67 a barrel. But I also saw our momentum indicators, another tool we have called Real Motion, was actually showing a bullish divergence. So I wrote an article and said, the analysts are wrong. Looks like oil is bottoming. And so that's where we are today. So that's kind of like my discretionary job here.
Yeah, I look for those momentum divergences. One of the few things that I use on the technical side as well. But so what about, you mentioned volatility. So do you keep much of an eye on measures of vol, measures of skew, things that the option market is telling you? Is that something that features in your process at all?
Well, we have options trading as part of our models. That's one level that you can go to. So I do look at it through that. Obviously, ODTE has been a big buzzword this year, as if that's new. It's not, but whatever. They like to come up with something new as like, this is the thing now. For example, like meme stocks, this is not anything that we're not familiar with back in the day, or even front running trading. That was certainly something that's always been happening. So getting back to options, I know I read on Twitter. I'm on Twitter all day long. Obviously you are too. And that's where I get a lot of information about the things that I may not necessarily pay attention to, people who are really good options traders that I will follow, that will put out that the volatility has happened, or there's a lot of call or put buying in the ODTE crowd. That's kind of how I pay attention. But I sense, and I'm not saying this to in any way, shape, or form say that I'm better than anybody else, but because I spent 14 years on the commodities exchange, I could look at ticks and get almost an innate sense of when volatility is going to pick up or when it's going to really moderate. And that's kind of where I operate from, sort of a sixth sense from just being old.
Intuition, right? It's,
Intuition based on experience. Yeah,
that's interesting. Yeah, no, I mean, of course, like you have to respect the years doing it, right? It's and sometimes you can't explain why you think a certain thing because it's your subconscious is just used to seeing these patterns, and patterns do repeat in markets, right? People who say they don't just haven't been trading long enough, right? That's the reality.
Exactly. I mean, it's so interesting to me because people do expect me to have an answer for everything, by the way. So I have had to think really on my feet occasionally. And here's a perfect example. So I was on Charles Payne this week, Fox, Making Money, and I followed Jim Bianco, who is obviously a very well-known, highly respected economist, trader, fund manager. I'm not even sure, 100% sure, all the things he does. But he was talking about a protracted bear market in the bonds that started in 2020, 2021, that was going to continue for 20, 30 years, that interest rates will never come down to the levels that we saw back in 2021, obviously, and would just continue to rise through the years. Okay, fine. I listened to that. I was actually in the virtual green room. But now, Charles, I'm on, and Charles said to me, well, what do you think about that? Do you think we're going to have a protracted bear market in bonds for the next 20, 30 years? Well, first of all, it's not, I don't even know if we'll have a bond market in 20, 30 years. I didn't want to say that. I don't even know if central banks will be a thing. I mean, we could be so digital and so cryptocurrency oriented, and the whole way of exchange of how things work from a monetary policy could change in 20, 30 years. I don't know. But what I did say, and this is the thinking on the feet and the sense and the intuition, is, well, we just bought the long bonds. We bought the TLTs because we saw a mean reversion on the momentum, because they looked like they were exhausted to the downside, and because I kind of already knew, when I say knew, I assumed, like everybody else, that the CPI was going to be soft coming into today's number. So I said to Charles, no, well, actually, I think the bonds may have bottomed and that the yields could actually relax a little bit here. So I would keep my eye on the TLTs. And that's what I'm saying, is that you always have to have some kind of answer when you're in the media.
Yeah, it's funny. We actually covered some short calls that we had on TLT recently as well, thinking it did look a bit exhausted here. It's kind of a funny inflection point in TLT. I mean, if it breaks below here, it's got quite a lot of downside, but it could easily bounce from here as well because it is showing signs. I also think the inversion in the curve is interesting, right? It's like if back-end bonds were really going to sell off hard, I wouldn't have thought the inversion would have persisted for so long, right? I just kind of think the inversion in the curve is just the bond market saying, look, yeah, you can take rates up as much as you want in the front, but we're just not letting the back follow because we know you're going to wreck the economy, right? And it's just a matter of time, and there's just degrees of that argument that kind of will adjust. So obviously we priced in probably too many cuts after the regional banking crisis. We had to take some of those out. But yeah, I kind of agree. I think maybe we've taken a few too many out now. Depends what kind of data we see, but we saw the first non-farms print that actually missed expectations in like over a year, right? The little telltale signs that the job market might be cooling at least.
Oh, Imran, that is so astute, and again, very eloquently put. Yes, I couldn't agree with you more. That's why we have our keen eyes on the long bonds in particular, because if that back end starts to soften and those bonds start to rise through the TLTs, essentially what the market is telling us, if you believe that bonds are foreshadowing, and I actually believe that in many cases there are, like, for example, the junk bonds have outperformed the long bonds now this entire year, which is like one of the ultimate risk-on factors. But getting back to the long bonds, if the long bonds start going up through the TLTs and that back-end yield starts to soften, even though the yield curve remains inverted, which of course is also something that usually spells recession at some point, then I think really basically what it's saying is, regardless of everything that has happened in this great big run that we've seen, we are probably looking towards more of a recessionary environment, and whether it's through the labor numbers or what have you, we've got earnings coming up. Something will make that happen. And actually, if the TLTs don't go up from here, and like you say, we just get a pop because things were so oversold, and by the way, so heavily shorted, and then they start to turn back down, let's say, and break down under that 199 level that they just got back through, then you're right. Then not only would it mean not necessarily that recession, but it could mean even worse. It could mean that we're going into a stagflation environment. That's what I've been thinking. That will persist through 2025 at least.
Yeah, that's what the UK seems to be going through right now. It's not painting a very pretty picture. Okay, so a few more questions before I let you go. Obviously, you've had a wealth of experience in markets, so you must have learned a lot of lessons, right? I know I have in over 20 years of trading. So, give us a handful of what are the main lessons that you've learned from the market in all these years?
Well, I think the number one lesson is to have a strategy. I am not a by the seat of the pants type trader. I was able to get away with that on the floor back in the day, but now, no. I mean, over the last 20 years, I live and die by my strategy. And when I waver from that is when I get into trouble. Because they say your ego is not your friend. It's not, particularly in trading. It's the worst thing for you. So I find that if I have a strategy, then I have a compass, in essence, that I can go back to when I deviate. Because let's face it, we're people, right? So we're going to sabotage ourselves, or you're extremely tired, or you're not feeling well, you've just had a fight with your significant other, or whatever it is. that seeps in. They used to say on the floor that the market was your best psychologist, and my goodness, is that ever true? So when you are off your game, and it happens to everybody, if you get back to your strategy, then you can also restart. This is the most forgiving business because you can always restart. I mean, that's what makes this business, I think, the best of any business I've ever encountered, is that you get a pass. You lose some money, if you control it, you restart. So number one rule is have a strategy and know that if you go off your strategy, how quickly you come back to your strategy is what makes you a good, sound, stable trader. The second thing is really, I try to eliminate the media, which is funny for me to say since I'm on it all the time, but I'm coming on it as a trader, not necessarily as a predictor, a great predictor of the economy. But I think you need to tune out that noise and really make decisions based on an understanding of what technical analysis. That's been my other second biggest lesson, is that the better you are at technical analysis, the better trader you are. And the simpler you keep it, the better you are. You know, when I look at somebody's charts that has 50,000 indicators on it, to me, I get blurred-eyed. I can't even look at it. I look at my charts are so simple. I have 4 time frames, 30-minute, daily, weekly, and monthly. I have 2 moving averages, 3 maybe on the daily if I include the 10. On the monthly, I have 2. And on the weekly, I have basically 2, but I've added exponential ones. I have volume indicators, and then I have my momentum indicator and our triple play, which basically shows you how any instrument is doing against the SPY, which is our benchmark. That's it. There's nothing else on my charts at all. And yet I've made the best decisions from just understanding these chart patterns. So that's the other thing. And then the third lesson I would really think is that, you know, you just have to really understand that human nature is not in our favor for trading, because we were built to fail, right? Our DNA understands failure way more than it understands success. And I think that's probably the biggest obstacle for people when they begin to trade, because when they're losing money, we can take pain. Man, can we take a lot of pain. And so it's like, oh my God, I know it'll come back, right? Because when we have pain, what do we have behind the pain? We have hope. So we hope it's going to come back. We live on our hope, and yet we take a lot of pain and we have a lot of unnecessary losses. And the exact opposite is true when we're making money. A lot of people, who especially the newbies or the inexperienced, will get out so fast when they're making money, they almost can't believe it. I made money? That's not possible. So you see, it's like, really, this is a field where you have to understand the psychology of mankind in general, because certainly you see the buyers buying at the top and the sellers selling at the bottom. They throw in the towel, usually at the turning points. But your own self, forget about everybody else, your own self, watch that in yourself and try to change that. And again, going back, the best way to change that is through having some kind of a sound strategy that you can really sink teeth into.
Yeah, for sure. There's value in systematic processes, for sure. I mean, I tried to marry the two a little bit. So I like to use discretion, just because it's a bit like a sport, isn't it? Trading, right? When you've done it for a long time and you can kind of temper your emotions a bit, you know, you're not going to get carried away. You do want to flex that discretionary muscle if you can get away with it. But having a systematic framework to identify trades, and then having an implementation that has good risk management, like, for example, optionality, which is my bread and butter and what I use a lot. I think those are things that help me try and find an edge in trading. And we all have our own ways to find edge, right?
Yeah. And by the way, I just want to say one other thing. I mean, I don't think there's you look very fit. And I think the idea of the mind, body, spirit is also extremely important. You have to take care of your mind. You have to take care of your body. And you have to have some level of way to center and ground yourself, whether it's through something more spiritual, or whether it's through doing something that you love, or being around people that help you stay grounded. This is a lifestyle. This is not just my career. This is what I do. This is what I live, and I take it as a metaphor into everything that I do in my life, right? So, cut your losses if something is not going your way outside of the business. And if something is feeling good, just keep with it.
Yeah, no, it's really interesting you said that, because I had a chat with Brent Donnelly. I'm sure you know him, of Spectra Markets, and he's written a few books, and we were like saying, he's traded for decades as well, and it's like, how has trading kind of shaped the way you live your life, right? What are the life lessons that you've learned from trading? Because that is what happens, right? When you trade for so long, a lot of it translates through to the way that you live your life and the decisions that you make in your life, and you're applying like the risk reward framework to the decisions that you make in your everyday life, things like that. And I was trying to get him to make his next book basically around that topic.
That's great. And also emotions, right? Because
Yeah.
if you learn how to control your emotion in trading, it's amazing how well that can translate into your everyday life, so that your first reaction isn't, oh my God. It's more like, okay, I'm going to separate. I'm going to look at it. I'm going to step back. I'm going to look at the macro of the situation.
Zoom out on the chart, right? Zoom out on the chart.
Zoom out, take a breath, and then go in with some kind of a problem solving strategy. So yeah, it's helped.
Yeah. Well, that's great. No, it's been a great conversation. So before we wrap up, why don't we? I'm sure everyone's dying to know, what you're sort of thinking and playing right now. So you mentioned inflation a little bit, but how do you? It's been an interesting year, right? The narratives have been flipping around every couple of months. Well, how do you see the rest of the year playing out? And what's the core themes that you're kind of going after?
Well, obviously, right now we're seeing the indices doing very, very well. And one of the things I've been looking at has been the 23-month moving average when I zoom out into a monthly, which really measures about a 2-year business cycle. So it's a 2-year business cycle within a much larger business cycle, right? It's 6 to 8 years. And then I see some people talking about 18-year cycles. So really pick your poison, so to speak. But for us, it's been the 23-month. And why I mention it is that all the other indices have gone through, and the IWM, the small caps, I think are so fundamental to what's going to happen in terms of the economy for the next 6 months. If the small caps can break out of there, and all they've done is tested it right now, then I do believe that even I will have to change my mind about the stagnation part of stagflation and say, okay, we're going to continue to grow economically, because that's the small caps is the stuff, right? The stuff that makes stuff, not the tech area. So that's the first thing. In terms of the inflation, my key indicators there, besides the fact that I think the TLTs are going to be very interesting to what they do here, is I've been watching the gold and the silver and the relationship between the two. And gold has outperformed silver pretty much a lot this year. There's been a couple of times where silver has spiked up to outperform. But if that flips, if the silver starts to really outperform the gold, and we're long both, by the way, then that could be a real indication for things are going to get crazier in inflation. And I would watch like something simple like the DBA, which is the ETF for the agriculturals, because there's a lot of problems with food that's going to show up there. It represents ags and soft, so it's a nice blend of things. Even has a little cattle in there, and some of the soybean meal, for example. And then the last thing would be the dollar, because everybody's so happy right now that the dollar is going down and feels that that's helping the market, and it is. But we know stocks and commodities can go up together until at some point, if the dollar continues to go down, and especially if the yields soften because the economy starts to sort of flatten out, or the Fed is worried about getting too aggressive and they step back and don't raise enough, that's really where you can start to see a lot of inflation spiking up. So that's what we're keeping our eyes on. And that, and we've bought a lot of basic materials. So we've been fertilizer. We've been long the cruise lines and all the hot things through the quants. So I'm talking strictly here from a discretionary standpoint. And from a discretionary standpoint, that's what, to me, I really, really have my eyes mainly on commodities as we're going into the second half, unless, of course, as I said, the small caps really prove that they have sustaining power up here.
Yeah, they're at a key inflection point right now, right? The small caps.
Absolutely.
Yeah. All right. Well, it's been a great chat. Really appreciate you coming and giving us your wisdom and your insights over such a long, illustrious career. Been a pleasure having you, and hopefully I'll get to speak to you again sometime.
Thank you so much. It has been such a nice pleasure to talk to you and get to know you a little bit. I'm going to definitely keep an eye on what you're doing on Twitter. So thanks for the introduction to make that happen.
No, it's great. Thanks a lot. Take care.
You too.